Okay, so presentation and analysis of receivables. I like to do these just because this is sort of a practical thing that if you were running a business, it's pretty good to be able to understand how these work. And if you're working for someone where they, if you have the understanding of this, it definitely won't hurt you. Okay, so the presentation of accounts receivable, we're reporting them at their net realizable value, or cash realizable value. How much do we expect to collect? And from doing this chapter, we know that that's going to be accounts receivable less the allowance for doubtful accounts. So if we had accounts receivable of 8, and the allowance for doubtful accounts was 2, we'd go accounts receivable 8, less the allowance for doubtful accounts 2, and we would report our accounts receivable at 6. That would be what we expect to collect. Accounts receivable, generally current assets, usually reported after cash and your short-term investments. Okay, so presentation's not too bad. Just a little bit on the analysis. The accounts receivable turnover ratio is pretty good. You take net credit sales, which generally will be given to you, but it's credit sales, not cash sales, because we're talking about receivables, and that's what we're trying to relate to here. And then it's divided by average accounts receivable. Anytime it asks for average anything, it's the beginning balance plus the ending balance divided by 2. So if we look at an example here, it says the company reported net sales of 20 billion. So we can just go, okay, so we'll just put 20, that's good. And then it says the accounts receivable at the beginning were 2.7 billion, at the end 2.8 billion. And so if we go 2.7 plus 2.8 billion, okay, so we get 5.5, divide by 2. That should give us our average accounts receivable, which would be, I believe, 2.75. So to get our accounts receivable turnover, we divide the 20 net credit sales by our average accounts receivable, and we get 7.27 times. Well, gee, is that a good number? We really have no idea. That means nothing all by itself. What we have to do is to look at, okay, so how are we doing? What was our turnover last year at this time? What was our turnover last month? What's the trend? And then you could look at, and how do other companies like ours, what's their receivables turnover? And so if you had to translate, 7.727 times, what is that really telling us? It's saying on average, we're collecting our receivables during this accounting period about 7 times. So if you were running a business, would you rather have your accounts receivable turnover ratio be 7, or would you rather have it be 2, or would you rather have it be 10? Think about that for a minute. So if you're collecting things faster, chances are you'd rather have it be 10 times, because we're collecting things that much more quickly. One way to help think about this, and at this point you want to be trying to think about, well, what does this really mean? And it helps me to figure these things out, is to do the collection period in days. And that's just, you take the number of days in the year and divide it by your turnover ratio. So if we take the 3.65 and divide it by 7.27, how many days do we get on average? It's about 50 days. Okay, so we get about 50 days on average it takes to collect. We're collecting our receivables on average every 50 days. So now, if our accounts receivable turnover had been 10 instead of 7, this helps us because now, on average, we're collecting every 36 days. And so you'd rather, if you're collecting money, you'd rather be collecting it faster rather than slower. Okay, so sometimes combining these helps you make sense of them. It's kind of silly to just memorize formulas and say, yeah, I guess I had to learn this, but these can actually be useful because it can tell you how well your business is operating.